Hey guys, I want to give y'all my honest thoughts on the market right now. So if we look at the S&P 500, it is basically at all-time highs right now, just $2 off all-time highs right now. And I was just thinking right now might be the perfect time to sell calls, collect that premium, collect that dividend yield. And since I don't actually own 100 shares of most of my stocks, like if we look at Meta right now, Meta is a stock I would most likely be selling calls on right now because I don't think it's going to keep going up. It definitely could, but I'm not exactly super bullish that is going to keep on going up. The perfect time to sell covered calls is when you think the valuation is really high and basically when it's at all-time highs. And since I don't own 100 shares of Meta or like Constellation Energy, this one's also hit a new all-time high today, and I would probably be selling covered calls on this stock, but I can't because I don't have 100 shares. So here's how you can actually get exposure to calls, selling covered calls, and collect that premium without actually owning 100 shares of a stock. So I actually like SPYI right now. So it's actually, you guys might call me crazy for recommending a covered call ETF, but right now it actually kind of makes sense to sell calls on the S&P 500. And here is an ETF that'll basically do that for you. So if you look at SPYI, another ETF that'll do this is like JEPI or JEPQ. Those are another two that I really like. So this one has an 11.7% dividend yield and an expense ratio of 0.68%. Just like I said, another one that I really, really like is JEPQ. I don't own any covered call ETFs, but these are some ones that I would kind of recommend. This one has a lower expense ratio of 0.35%, 9.6% dividend yield, and they'll pay you actually monthly. So this one sells covered calls on the NASDAQ. Another one that sells covered calls on the NASDAQ is QDTE. And this one's really interesting because this one will actually pay you every single week. So we know JEPI and JEPQ pay you every single month, but check this out. This is literally crazy. This one pays you every single week. So one share costs $42. And every week, or in the most recent week, they paid you 21 cents. So that's kind of crazy. So here's a way you can get exposure to selling calls. You don't have to sell anything. Maybe just buy a few shares of this, and it's kind of like a hedge if the market does actually go down. Because if the market does go down, instead of just owning the S&P 500, you actually now own the S&P 500 plus that premium that you collected. So you're actually doing better off than the S&P 500. But there is a few things you do need to be aware of. Like if you look at an ETF like TSLL, or TSLY. There are some covered call ETFs that I don't love. Like look at this one. Just in the past year, it is down 53%. And if we look at the underlying asset, which is TSLA, TSLA is actually up 0.72%. So that is a huge difference. Why is there such a huge difference in the two? That's actually because TSLY has a super high, super crazy dividend yield. So check this out. The 30-day SEC yield is 4.18. So all we got to do is do 4.18 times that by 12. 4.18 times 12. That'll give you the 4.18 times 12. That'll give you the annual yield. So they actually have a 50% dividend yield. So if we add back the dividend yield, that would still be a negative 3% return, and that does not include the taxes you would pay on the covered call ETF. So as you know, when you receive dividends from them, it is not a qualified dividend. Like, what's a qualified dividend? For me in my tax bracket, I would pay 0% tax on a qualified dividend, and it's taxed at long-term capital gains tax. Like CRM, if I get a dividend from Salesforce, this $3.20, I will pay 0% tax on that in my taxable account. But if I owned a covered call ETF in my taxable account, I would pay taxes on that. It gets a little complicated. Let me know in the comments if you have any questions. Like Realty Income right here, this is one that I do pay tax on. It's taxed at long-term capital gains tax because it's a REIT, a real estate investment trust. But yeah, that's kind of the few things I wanted to share with you. I really wouldn't call anyone crazy like for buying a covered call ETF right now. I'm short-term a little bearish, but long-term market, 1, 5, 10 years out, I'm trading America. I think stocks are going to go straight up. So that's why I think if the stocks are, going low, keep hitting new all-time lows when it's buy the dip time for stocks, that is when you don't buy the covered call ETFs, in my opinion. You should probably buy the covered call ETFs, which is a neutral slash bearish strategy when the stock market is at all-time highs, like the QQQ is right now, or the QQQ is just a couple dollars off all-time highs. And we have some stocks at pretty high valuations, and I'll actually show you that right now. So let's actually look at the stocks that make up the majority of the S&P 500. So let's go through these. Like if we look at Apple's valuation right now, look at the forward PE ratio and the trailing 12 months PE ratio. They're trading at 33 times earnings. Let's look at Microsoft. Microsoft is trading at 31 times earnings, a little cheaper than Apple. But here's Nvidia. Nvidia is actually trading at a forward PE ratio of 44. So that one is a little bit on the more expensive side. But also Nvidia has a really high expected growth rate. So stocks with a really high PE ratio can usually sustain the high PE ratios if they keep up the growth rate. Now, here's a stock that I think is at a potentially really undervalued price. Remember, none of this is financial advice, personalized advice, nothing like that. But look at the forward PE ratio on Google. It's literally a 22. If you compare that to Apple or Tesla or any of these other Magnificent Seven stocks, Google is the cheapest on terms of evaluation, and even Meta is relatively cheap. They're at a forward P ratio of 28. That one seems good. Amazon has a forward P ratio of 39. So as you can kind of see, most of the biggest names in the market are trading at really high valuations. Like we actually, we have our Google shares, and just because it's trading at a fair valuation doesn't always mean the stock is a buy, but I do own 12 shares of Google. We're just barely up 2.78% on Google. We also own some Meta shares, which I didn't even buy the stock at all-time highs. Look at their year-to-date performance. So year-to-date, Meta's up 70%. We're only up 34%, and I did not expect this one to just keep going higher like that. It's always so unexpected when your best performers actually do really good. And I'll actually show you this stock right here, or this portfolio, this one individual stock in here. It just keeps hitting new all-time highs. This is Powell Industries. We're now up not just like triple, right? 210% is a triple on a stock. So this one has been incredible. We bought all of our shares at $80. As you know, once I buy a stock in this portfolio, I can never sell it for the rest of my life. But hey, honestly, I was thinking about selling shares, but I can never sell shares in this portfolio. Maybe it would be smart to sell covered calls on Powell Industries. Remember, I think it's smart to sell covered calls when the stock is at all-time highs. Don't sell calls when the stock hits new lows. When it's buy the dip time, that's when you buy shares. I think the time when you sell covered calls is when the stock hits new all-time highs as a way to just hedge. Remember, I don't recommend doing this as a huge part of your portfolio. Buy, JEPQ as a hedge to the S&P 500 as you think it's a short-term bearish. And one more covered call ETF I'll leave you with. Don't forget to drop a like on the video. Thanks for watching. Is SVOL. This one actually sells covered calls on literal market volatility. So if there's news in the market, that makes volatility go up, you can benefit off that. You can get exposure to this, but remember the high expense ratio and the dividend yield of 16%, you basically chop off 15 to 20% of that in taxes. But if you own it in a Roth IRA, completely tax-free. If you got any comments for me, don't forget to drop it in the comments and I'll check it out. Thanks for watching.